if you missed this rally, I wouldn't buy here. I would wait for a pullback to a decent level of support, work off some of the short-term overbought condition to add exposure to your portfolio. The rallies happened. It was very fast. It was very vicious. My point is that the market is going to give you another opportunity to invest capital if you miss this rally.
Right. And what I'm taking from you is don't chase this right now.
Yeah. You don't want to chase markets.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the Angliophile and portfolio manager extraordinaire, Lance Roberts. Lance, how you doing?
Okay, I'm gonna have to ask you, Angliophile. I do not know that word.
That is somebody who is a big fan of England and all things
Oh,
English, British. You were just over there in the UK last
yes.
week. How was the trip?
I am not a fan of all things British.
Way to go. You just like totally, insulted what,
No, I'm just
4% of our audience here?
yeah, no. I said no. I didn't say everything British. I just said not a fan of all things British. Like I do not understand mushy peas. I'm not okay. So first of all, I'm not a huge pea fan to start with. But I don't understand why you mash them up. And just serve them with fish and chips and all kinds of stuff. So I'm not a big fan of mushy peas, but no, the trip was great. As I said before, my wife's aunt had gotten married to a British gentleman, and all of his family, his kids, everybody, they still live in England. So they had the wedding in the US, and then they had the reception at a place called Lake Windermere in England, which was on this really beautiful lake. And right
Sounds
next,
fancy.
yeah, it was great. And so it's an old manor. It's like 200 years old, and everybody, there was like 40 people, staying in this manor. And so we would have, breakfast and stuff. You walk about a quarter mile into town, and there's a marina there with boats that go out on tours on the lake and all kinds of stuff. And then, there's town. So we would just walk into town, have coffee, get a Danish, whatever, kind of do some window shopping. It was very nice. Weather was beautiful the whole time. We got very lucky with the weather. It was supposed to be, kind of typical UK weather and raining, but it was absolutely beautiful blue skies. Best part of this whole trip is in the backyard. So you come out of the manor and there's this big kind of sitting area and it overlooks the lake. Well, on both sides of this lake are these what they call mountains. They're just really, really big hills. But the lake is embedded inside of this kind of ravine with these hills on both sides of this lake. And the lake's very elongated. So like it's a 30-minute trip. You can get in a boat and 30 minutes away, there's another town you can go to and go visit and have lunch, then take the boat ride back. So what's interesting though is that we'll be sitting out there, and about every hour to hour and 45 minutes, there will be three Eurofighters come screaming low level flight through this ravine. This is like Top Gun Maverick, right? Training for the mission. They would come through doing low level flight training down this ravine across the lake. So you get this air show the whole time you're there. It was an absolute ball. I'm a military freak anyway, so I think everybody else was annoyed by the sound, but
I was going to say, I'm sure a lot of people are like would totally ruin the pastoral tranquility of it, but
yeah,
the Texan here is rooting
yeah,
for it,
yeah,
huh?
it was great for me. I loved it. So, but yeah, it was a lot of fun. But no, it was great. We took a train from London. We rode the train from London over to Grantham. We met our son there. He picked us up, drove us to Windermere. So we just spent, it was mostly there to see our son and kind of visit the new family that we had met before. So I now have a much bigger extended family I had no idea about. So, but I thought one of the funniest things is that the Thursday night, one of the last nights we were there, they wanted to have a dress up party, like a costume party for everybody. And so there's only probably 8 Americans in this whole party, and the rest of them are all people that live in, kind of in England or in Scotland, very close by.
Mm.
And so everybody dressed up. There was only one person dressed up as Ozzy Osbourne. Everybody else was dressed up as an American character of some sort. It was the Blues Brothers. It was Top Gun Maverick and Goose, Indiana Jones. So, it's funny that their favorite characters are all American. That's what
The
they're
American culture is infecting over there.
exactly.
Well, I got to ask, what did you go as?
I went as me because my wife and I, by the time we got there, we were so tired and all that stuff. We just didn't pack for a costume, so we were the
Oh my
oddballs
gosh.
out.
All right. Well, gosh. So it sounded kind of like a Downton Abbey experience, and you were kind of the rich American cousin transplant that came on in and infected everybody with your Americanism.
No, so yeah, it's funny. No, that side of the family,
Sounds like they're already infected.
they're very wealthy. So yeah,
Okay.
they yeah, I pale in comparison.
Okay. So your aunt married well, is what you're saying?
Yes, she married very well. Yes,
All right. I'm just thinking you were there. The American cousin there, the American cousin random trivia point was the play that Abraham Lincoln was shot at. You probably know.
exactly.
Yeah.
Other than
Um,
that, how was the play?
yeah.
So
Other than that, how was the play? All right. Well, look. Other than that, glad you had a great trip. Uh, a lot's been going on while you've been gone, and actually, a lot is going on as we are speaking right now. So, forgive us, folks. We're recording this morning time on Friday. So when you see this on Saturday, there might be a few more developments that have gone on either in the world or in the markets. But hour or so before Lance and I have gotten together here, Iran has announced that the Strait of Hormuz is, in their words, completely open at this point in time. Markets seem to really, I mean, they've been warming up all week, but they seem to be really believing now that there may very well be an end to this war. They've certainly priced in the end of it, Lance, right? Because we're at all-time highs on the S&P. And I definitely want to walk through the technicals with you to see how much legs you think this bounce is having in the market. Um, but there's a lot going on. I mean, we can maybe start to have a little bit of optimism here that this Iran conflict may actually have an end in sight here. And like I said, so far, party in the market. So I guess where do you want to start on this, Lance? Do you want to start with
well,
TA? Do
I think
you want to
I
start with
think
the
well,
geopolitical
I
politics?
think I think the first place to start is that all your viewers need to thank me personally for going out of town because apparently when I went out of town, that's what sparked the rally. So
Yeah. I thought you were going to say because you were out there actually, it was a clandestine trip to negotiate the final
yeah,
terms on this.
no,
That
no,
they'd recruited you for your negotiating skills.
no, it's just funny because normally when I travel, the markets crash. As soon as I try to go on vacation, something bad happens typically. And so I'm trying to deal with clients and everything else while I'm traveling. And this time the market was just rallying the whole time. I was like, this is great.
Yeah. Well, on that part, I mean, the markets really have been sniffing an end to this conflict before the end of the conflict has arrived here. Do you think the markets, I mean, we don't know for sure, but I guess to my question is before you left, leading up to before you left, we've been looking at the technicals and the markets had been below basically the 200 daily moving average, and you were talking about depending on how long they stay down there, history shows that the markets then perform pretty poorly the longer it stays down. And you had said if it pops above, we're going to sell into strength, which I believe you and Mike did do initially. What are you doing now? Are your models giving you an all clear at this point in time, or are you still on the defensive?
So no, we're actually full offense now. So a couple of things. One, so you remember when I guess it was 3, 4 weeks ago, I wrote an article talking about the 200-day moving average. And the result of that study was basically is that if the market stays below the 200-day moving average for longer than 4 weeks, then your forward returns over the next 3, 6, 9, 12 months are typically negative. Not drastically negative, but typically negative, 3, 4%. However, if the market gets above the 200-day moving average with below that time, less than 4 weeks, your forward returns are very, very good. 3 months, 6 months, 9 months, 12 months are very positive, and typically you're up double digits by the time you get to 12 months. We were below the 200-day moving average for 3 weeks. So when I actually left on vacation, the markets popped on Monday, and we started adding exposure. So this is not this past Monday, the Monday before this. We started adding exposure. So I'm sure that Mike was talking to you about our trades last week.
Yep.
So we closed out we had short hedges on our portfolio. We took those off. We started adding exposure to the mega cap names because the mega cap names were the ones that were most beaten up. And it was interesting because everybody was chasing value stocks in name, but those really weren't value stocks. they were very expensive fundamentally. Tech stocks have had a huge correction in valuations, but the strongest rate of earnings growth and forward earnings growth is still very strong and actually being improved right now. We talked about, I think the last time you and I were together, we talked about this, kind of phenomenon of where valuations were and the markets were correcting sharply. We corrected valuations on the S&P by 18% because the P was coming down, but the E was going up. And
Right.
analysts were getting very excited about this stuff. So starting really last Tuesday, we started increasing exposure. We bought more this week. So we're back to full target weights in our portfolio now. And, there's going to be a pullback here. And we can talk about kind of the technicals in a minute, but there will be a pullback here to either the recent breakout to all-time highs or maybe the 50-day moving average. But that's going to be where you want to start buying the market, not selling it.
Okay. Although you said start buying the market, you guys actually are
Yeah,
buying the market right now, right?
well, no, we already bought it.
Yeah.
We'll add more on a pullback, but if you missed this rally, I wouldn't buy here. I would wait for a pullback to a decent level of support, work off some of the short-term overbought condition to add exposure to your portfolio. The rallies happened. It was very fast. It was very vicious. Yeah, the Nasdaq's been up for 13 days in a row. That's one of the longest runs in history. The S&P put on 12 days now of back-to-back advances. That's one of the longest stretches since 1950. Forward returns from those two environments are very, very good. 100% win rate over 12 months and 24 months in general.
Okay. All right. Just, I'm sure you'd want me to say this. From the data you've looked at 100%, there's no guarantees in life. Doesn't mean it's going to happen this time around, but the
For sure.
odds look good, right?
Yeah, yeah.
Um,
The statistics, and that doesn't mean that you're not going to have bumps along the way. I fully expect this summer we're going to have another 5 to 10% correction heading into midterm elections. And then you'll have an end of the year run. That's just normal statistics and how markets work, particularly in midterm election years. So my point is that the market is going to give you another opportunity to invest capital if you miss this rally.
right. And what I'm taking from you is don't chase this right now.
Yeah, yeah, you don't want to chase markets that have moved. And again, remember when we were talking 2 weeks ago, I was telling you that technically the markets were extremely oversold. Bearish sentiment was extremely high. Investors were very offside. We had record short volume in the markets. Put options were running at like the third highest level on record. Those are all contrarian indicators. That was the gasoline on the logs. And all you needed was some type of catalyst. And as soon as they started talking about a peace deal, boom, this market was positioned for a huge rally. And if you remember 2 weeks ago, you and I were talking, and you said, well, if you get a peace deal, what does that mean for the markets? I said, hey, we're probably going to get a 10 to 15% run. And you were like, really? And I was like, yeah, really. And we're up 12% now.
So yeah, and I want to give you props there. So I'm actually looking at the thumbnails of our recent weekly
Yeah,
market recap videos. So that one you're talking about, that thumbnail, that video was titled "Markets About to Scream Higher?" question mark. And then with Mike last week, the title was "Have Stocks Bottomed?"
there you go.
And so you guys were basically saying, hey, it is looking like this thing. You were saying it's looking like this thing could
Yeah.
is coiled here potentially. And then Mike was saying it looks like the bottom's behind us. And what's interesting, I just want to note this is, um, we talk about how get a lot of feedback from people who are like, "Oh, you're just so bearish all the time." We're not. And these are great examples of that. But what's so funny is those videos are watched notably less than the ones that are more concerned, right?
Yeah.
And I don't try to play the clickbait game or things like that, but it is so interesting that there's so many loud voices that are like, you got to be more positive, you got to bring more bulls on. And I have. And when I do, people don't watch nearly as much. And I'm still going to bring them on because it's the right thing to do, right? But it's just so funny that when people are kind of, some people are screaming for more of, when you actually give it to them, they don't want it.
I know. Well, it's just the same with me, right? I get a lot of, people that watch me here with you, and then they get on my X feed as an example, and they make comments on my X feed. It's like, oh, you're just a permeable. I'm like, if you read our work, I mean, we've been writing articles for weeks about breaks the 200-day moving average, what the risks are, what the risk is to the market right now, why breadth is a concern. We write a lot of stuff about risk management and kind of more of the bearish side of the market because our job is to protect capital for our clients and navigate these market events when they occur. But what we're also looking for, this is one of the biggest challenges that's been over the last. I think what I'm about to say, I think, is the biggest problem for investors that lean into that more bearish view. I've been watching a lot of people on X as an example, and and you interviewed a couple of these guys in particular, and they're like, "Oh, this Strait of Hormuz closing, it's going to lead to the next financial crisis and all this stuff." And there's no evidence to support that at all. And we've had oil crises before; these things occur. But what these bearish predictions of presume is that this is going to remain this way indefinitely. And the markets are just not even aware of what's going on. And that's a very flawed view of analysis. So if you're doing that type of analysis, it's a very flawed way to look at things because markets are not static, they're dynamic. And every day, right now, this moment, there are millions of people in the markets, and there are bearish people and there are bullish people, and they are both buying and selling in this market right now, today. And every second of every day, these buyers and sellers are in the market, and that's what's setting the price. So so this whole decline that we had, concerns over Iran, the price of oil, the closure of the Strait of Hormuz, all that, the markets were actively pricing that risk into the markets. That's why we had this valuation correction in the markets of 18%. That's why we had the decline in prices. The markets were pricing in these expectations of what that could mean for the markets, for the economy, for the Federal Reserve, all that. So as soon as that weight cleared, they then started pricing out, oh, now with this reversing, oil's down to $80 a barrel now from 100. That's going to be a big relief on consumers. That's going to help earnings growth. The economy is going to help. That's going to help the economy pick up here. That's going to bring down inflationary pressures. That'll allow the Fed to cut rates. That's why the market's rallying, because now we're pricing in what the expectation is of this. So the big thing, and this is why you and I focus so much on technicals every week, the technicals are what is telling us what the market is saying. This
Right.
is what the market's thinking. Pay attention to that. If you pay less attention to these, end of the world doom and gloom scenarios, you'll perform much better in your investments over time.
Well, okay. So a couple of things. One, I think that's in general a truism, right? Which is that emotional narrative-based decision making is not nearly as good as the framework that we talk about a lot in this channel,
Right.
right? Just um, now that being said, uh, the market is the conglomeration of all the inputs that go into it, right? So
Right.
when the market's down 18%, that's because there are some people who think the market's going to go down 90%, and there's some people who think it's going to go up 40%, and the market's finding middle ground, right?
That's right.
But it's
When there's a buyer and a seller, everybody thinks they're right. So
right, exactly. Each side thinks they're right. And that's kind of where I'm going with this, which is I think I know an individual that you're referencing with that, because I think most people I've had on it's been a spectrum.
yeah,
What is interesting is one or two of the people who I've interviewed who have been more dire. There's conversations you have on camera, and then there's conversations you have off camera,
right.
and at least one person who was quite negative about where this could have been going. Um, I think had a lot of faith in their sources. So
Yeah.
they had sources which they claimed were, close to the military, in the military, that were giving them, information that was making them believe that things were very different in a worse way than what we were reading about in the headlines. And so I just wanted to say part of the story is it's not just beliefs per se.
Mhm.
But it's also information sources. And Lance, I'm sure you're like me, right? Where you've gotten hit from all sides from people when you make an objective comment about where the war's going. Everybody's got their choice information sources, and they're all over the map, right? So if you say something that contradicts what someone's trusted, quote unquote, trusted sources are telling them, you oftentimes get blowback from them. So I think one of the lessons to come out of this is be very judicious about what sources you believe. And I would say for everybody, as we talk about often, like don't just live in your echo chamber. Like
Yes.
actively look at
Last
other sources. And if they're contradicting what the sources you like are saying, really try to do the work to say, okay, well, look, is there truth in there? And are my sources biased or wrong in some way? And do I need to kind of, evaluate or equilibrate from where I'm my current position? And your research may lead you to believe no, the other sources are wrong, or hey, my sources maybe might not be perfect, right? So the point is there is really try to do the work. And that's one of the things I do on this program is I don't just bring on people who have the same opinion about everything. And we're going to talk about some of this in a little bit here. Really do try to listen to a range of people. I try to do a good job on this particular platform, but I say don't just listen to this platform either. Listen to a whole bunch, read from a whole bunch of different sources. So, keeping that open mind and really trying not to get too colored by A, the sources that you prefer to listen to, and B, just know that if you're on media these days, most of it's digital, there's an algorithm at work too. So be very mindful about what's getting pushed at you. Um, I'm not necessarily saying there's a bias against it, but it is an equation that is looking at what you normally look at, and it's just trying to feed you more of it.
Right. No, the confirmation bias is the biggest problem we have. And that's why if you read our work, so if you follow me on X as an example, sorry, on Substack at Lance Roberts or on Real Investment Advice, we publish 2 blogs a week. We publish a newsletter on Saturday. Mike publishes an article on Wednesday. And when we're writing, you'll always notice that we present a bull case and a bear case. We say, this is what's going on in the markets. Here's the bull case. Here's the bear case, because we're always trying to evaluate both sides of the argument. Because again, I have a lot of sources that I rely on, but the biggest source that I rely on a regular basis is raw data. Just give me the raw data. Let me do the analysis from that data. And so what's really important is, to your point, it's really easy to get sucked into confirmation bias. I'm only going to listen to this group of people because I think they're really smart, but they're all the same and they're all giving you the same narrative. The world's going to end, the debt collapse is coming, it's the end of fiat currency, whatever it is. And that leads you down a pathway of negativity. And negativity feels good, right? As human beings, it's weird, but we love train wrecks, right? So, we slow down to look at car wrecks. So as we're driving down the freeway, we will stop to watch a train wreck. We want to know what the latest plane crash is. We're inherently biased towards tragedy, and the bearish case always sounds very intelligent. And there's nothing wrong with the bear case. It is very intelligent in a lot of cases, but the markets respond differently. And this is what I'm saying is, like, it's okay to have this fundamentally bearish case about the outlook of the world. That's okay. And eventually it may happen. We may have a debt crisis someday. We may have, lose fiat currency status someday. That may happen. But when is the question? If it's 20 years from now and you've only got 10 years to your retirement horizon, that's a huge difference. And if you've
Right.
underperformed the markets for, being bearish, expecting this big event to occur, as Peter Lynch would said, more money's been lost in preparation for a crash than during the crash itself.
So,
So,
yeah.
and
Yeah.
and so again, just focus on making. That's why I'm here with Adam every week. I'm not bullish. I'm not bearish. We manage the markets. We manage risk. That's all we do. And the markets are inherently biased to the upside 80% of the time. So we give that appropriate weight, that the markets are going to look through these events and they are going to resolve these events by correcting valuations, which we just had one of those events. We had one last year in April with a tax day situation. And then markets are going to come back. And so we want to make sure that we're growing our client wealth, and you want to make sure you're growing your wealth. It's okay to hedge and to prepare for this end of the world event whenever
Right.
it occurs, but don't bet your whole portfolio on it.
Right. And you just did that, right? I mean, you put shorts on your portfolio, I mean, not that long ago.
No, no,
Um,
we had it for
but
like
you took them off because, what you were looking for finally happened. And as I remember you saying, whatever it was, 3, 4 weeks ago, you said, I hope I lose money on this hedge because it means my major position is doing better. And of course, that's how it's played out. So all I want to, the little coda I just want to put on this is what you were saying about the importance of looking at technicals and what the market is saying. I'm a big fan of fundamental investing in the long run, although, any fundamentalist investors lost a lot of hair over the past couple of decades.
both.
But at the end of the day, in the present, all that matters is what the market thinks, right? And so you can have a really good logic fundamentally. And to your point, Lance, it might actually prove out in the long run but it doesn't matter until the market thinks it matters. And so it's really important, especially when you're in an environment like the past, week or so, where there's still a lot of negativity in the news and in the headlines, but the market starts reacting as if things are improving. And you really got to ask yourself at that point in time, is the market pricing in something that just the headline readers are not seeing yet? And that seems to have been the case. Now, did the markets really know that we were this close to a peace deal? Um, I don't know, but clearly the collective wisdom of the market got a lot more optimistic about what,
Yeah.
7, 10 days ago, right?
No, absolutely. And again, this is, again, the point that you're making, and it's absolutely right, is look, we just need to make, our goal is to make money, to grow our wealth so that we can financially be in the position to retire or to take care of our families or whatever we want to do.
Right. Stay retired.
Stay retired. And all these things are out there, and there's a lot of this stuff that just kind of weighs on investors. But this is why investors over time underperform markets, because we wind up selling lows, buying highs. I mean, how many investors were selling the bottom 2 weeks ago because they thought, this was going to explode into some type of massive recessionary environment. Now the opposite of that is we're having this big rally, and my feed is just filled with, oh, it's just a short covering rally. We're going to go right back down to the lows. That's possible. I'm not going to deny that's not true, because it is possible. If this whole deal falls apart and tomorrow the straits closed again and we're launching missiles back into Iran, this market's going to sell off. Absolutely, 100% for sure. However, saying that, historically speaking, when the markets rally back above the 200-day moving average in less than 4 weeks, you never had a death cross of the 50-day moving average crossing below the 200-day moving average. That didn't occur. The 200-day moving average is sloping higher. It's not flat or declining. That's bullish, by the way. The 50-day moving average is turning back up. Now, that's bullish. In those type of environments, when you have that kind of sequence of events and improving breadth, which we have going on right now, we're at about 60% breadth, which is good. It's improving from 30% where we were. It's moving in the right direction. Today's a good broad rally in the markets, is a good example on Friday here. Normally in those environments, you do not get a retest of lows. You do get a pullback to support, but you do not test or break the lows. So that's just part of the risk management of this. And we added some positions, starter positions in companies that we really like, have been wanting to get into. We were able to get into them a lot cheaper. And I'm hoping this market gives us a pullback to where I can buy some more of those shares at even a better price. But
Okay. Hey,
that's
do me a
that's
favor, while you're talking, can you pull up the S&P here just so we can get the technicals out of the way? Um, so I'm curious, does your default expectation here, it sounds like it's, hey, at some point there's going to be a little bit of a pullback, right? Market, as you can see here, it's just had a string of great days here, right?
Yep.
Classic, massive V bottom here. Um, what would you expect it to go down to test support? Would it be the 50, the 100, the 200?
So good. That's a great example. So this colored bar on the right-hand side, that's a Fibonacci retracement scale, right? So what that looks at is just the run of the market from the recent low to where we are now. And just assuming that today, if the market ended where it is right now, and tomorrow we started a correction on Monday, right? We started a correction. Then the first pullback would basically be more or less to this string of kind of previous highs that we were at. And that's about a 23% retracement from the peak. So on a Fibonacci basis, you're looking for a pullback to around, 68.41-ish. So sorry, 69.41. But anywhere along these previous tops where the market would pull back, find support there, and then begin to rally, that would be good. Now, I don't really think that a pullback to these previous tops is going to be enough to reverse this pretty massive overbought condition we've got going on right now. So we were very oversold 2 weeks ago.
Oh,
We're
look at
now
that
very
swing.
overbought. Yeah, it's been a huge rally. And I'm gonna show you a little bit longer picture of this here in just a second, because it's interesting what's going on.
Okay. Hey, and I just want to interject
Yeah,
because I like to get my digs on you when I can,
sure,
but
sure.
I also want to call you out when you're right. Back there at that low. right? The RSI low down there,
Mhm.
oversold reading. That pretty much was when we put out that video where you had said markets could scream higher from here. And I think it is hard to describe what they've done as anything other than screaming higher.
Yeah. And look, I'll be honest, I told you 10 to 15%. That was off the cuff at the moment. I hadn't really thought that through at all. So that was a little bit, I really didn't expect a rally of this magnitude. It's been really amazing. And again, this is one of the strongest rallies in such a short, compressed time frame. We haven't seen a rally like this since the bottom in 2020, in March of 2020, when the Fed came in with $120 billion a month in QE and the government started sending out stimulus checks.
Is that true? Because I feel like the rally off the Liberation Day lows was pretty face ripping too.
It was, but it wasn't nearly as sharp. Here, let me see. Here's the rally off the lows. It took it took basically about a month to get to new highs, but it was also a deeper decline. To be fair, this was a 20% decline.
Yeah, 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 exactly.
It
So
had
I
a lot
mean,
it had a lot further to go for sure. But it was a pretty sharp rally. But again, if you just look at the angle of ascent, it's actually steeper right now.
okay, but they're both real steep. Hey, real
Both
quick. So if you look on the Liberation Day rally there,
are.
there is what I believe is called a breakaway gap,
Yes,
um,
right here.
right there. And it seems like we have the same thing going on in this rally. True?
Yeah, and two things too. And so going back to what I was saying a second ago about people that are predicting this is just a short covering rally, we're going to fade back to the lows. Kind of a difference in it. This purple line, this is the 20-day moving average. That 20-day moving average stayed below the 20 and the 50 for a good period of time before it actually recovered back after Liberation Day. Again, deeper decline. Got to keep that in mind. But once the 20 crossed above the 200-day moving average, it stayed above it the rest of the time. And we're crossing above that 200-day moving average right now.
Okay.
So again, just now again, that doesn't mean we're not going to get a pullback. And I suspect that we're going to get a pullback to the black line, which is basically the 100-day moving average. That's going to be first real test of support. The 50 days right below it. So there's a cluster of support right here. And I think a pullback to that level would certainly it should be expected. And of course, when that happens, the media is going to say, see, it was all a short covering rally, the bear market's back, blah, blah, blah. No, that's just going to be a pullback to work off this overbought condition. And I was going to show you this here in a second. Remember, we were talking for about a month and a half about this negative divergence in relative strength. The market was going up and relative strength was falling. You had this negative trend in relative strength that we've completely taken out now. So this is the first time that relative strength has been above 70 since going back to September of last year.
Yeah.
So
Which isn't shocking only because we've been stuck in this trading range since basically the end of September, and now we're finally broken out above it, right?
exactly, but that's very bullish, by the way.
Yeah.
So
So
that downtrend and relative strength is very bullish.
okay, so lots that could happen here, and there's still non-market developments that need to be finalized one way or the other. But it sounds like your default expectation here, Lance, is yeah, we'll probably get a short-term pullback in the near term, but that this is the start of a new bull trend, and that
No, I
you
would say
expect the S.
no. Disagree. This is not the start of a new bull trend. We didn't break the bull trend, right? This is just a continuation of the
Okay, sorry, the resumption of the bull trend.
yeah. And then,
But
that's a very important distinction. October 2022, we had a 25% correction in the market, so we had broken the bullish trend, right? So that when we bottomed in October 22, that was the start of a new bullish trend. This is just a continuation. So there is a distinction that I think is important for people to
okay,
understand.
no, important distinction, but rubber meets the road.
Yeah,
Your default expectation is higher prices ahead after this
correct.
likely near-term pullback. Now, obviously, that
Yes.
could change, right? Things worsen in Iran, like
Something else happens.
yeah, or something else happens. But and that's why I said we kind of have to see what happens with some of these non-market uncertainties that are still out there. But it sounds like you've already started, reloading. You'll load back up even further if you get this pullback, positioning for a nice continuation of the run and higher prices from here. You're
Yeah,
nodding as I'm saying all this. Yeah.
yeah, absolutely.
Okay. All right. So, good news then for investors who are looking for future gains ahead from here. And if you are complete, so let me ask you this, Lance. For
Mhm.
somebody who was concerned about what was going on with the war and really went to cash and hunkered down, right, when full risk off, what would your advice to them be right now?
So let's just pick a number. If I had $100,000 in cash right now, what would I do with it? I would think about it in either, 6 months or a year, however fast you want to go. And I would take that fraction. So let's say you want to get allocated back to the markets over the next 6 months. Take 1/6 of your money and buy stuff today. I would look for companies that have had a big correction recently, coming off support. If you're buying individual equities, if you're just buying an ETF, just buying an S&P 500 ETF, that's fine. But if you're looking for individual companies, buy companies with strong earnings growth, have strong earnings expectations. We're right in the midst of earnings season right now. So we're about to get a buttload of earnings coming out. So there's going to be some opportunity over the next 2 weeks for companies that come out, report good earnings, but maybe the stock sells off a little bit because their outlook was a smidge weaker than expected or whatever. Use those pullbacks as an opportunity to add to some stocks that you want to own. And then just every month for the next 6 months, just repeat that process. Once you have money invested in companies, it's easy to buy more. And so as you get money invested, just kind of keep adding to it until you get your portfolio reallocated. This is one of the most important lessons that investors should learn. You should never go to 100% cash because you run into this problem. It's like, oh, I was really worried about this event, so I went to 100% cash. Now the problem is how do I get back in? That's more challenging than getting out. Getting out is
Yeah.
easy. Getting back in is really hard. So once you get, and this is why we never go to 100% cash ever. We'll hedge, we'll sell equities, we'll raise cash, but we never go to 100% cash because of this inherent problem. It's much easier once you have a portfolio allocated and say I've got my portfolio built. I've got my 20, 25 stocks I want to own. Well, when risk comes up, you trim some of those back, you take profits, you raise some cash levels, maybe add some fixed income in to hedge with, whatever you want to do, but never go to zero because then once the market begins to correct, it's much easier at that point to take capital and just buy stocks back that you already own. I already own Microsoft, I just add to it. I own Google, I add to it, whatever stocks you own, you just add back to them as you get opportunities. And so it's much easier to navigate markets over time by just I was explaining this to my wife the other day. She's like, I really don't understand. I've listened to your show in the morning and I don't understand, the turn day moving average and all this. Why do you do all that? And I said, well, think about it this way. You drive like a bat out of hell. So when when you're in your car and you're driving 80 miles an hour down the freeway, you're not really worried about anything, right? Because you feel like you're in control of the situation. And I said, well, you just don't drive 80 miles an hour. If you start to see flashing yellow lights ahead, or you're crossing over the hill of the freeway and you see some police lights down the road a bit, or brake lights coming on, you tap on the brake and you start to slow down a little bit. Maybe you think about exiting the lane you're in to get in a different lane, but you're mentally adjusting for risk when you're driving your car all the time. And it's the same thing in a portfolio. Just adjust for risk by tapping on the brakes, adding a little bit of gas, changing your allocation a bit if you need to. If you're really overweight one sector that's underperforming, maybe add some of another sector that's performing better. But just manage the risk, manage your drive as you're going, and you'll get to your destination safely. But trying to stop the car, get out, wait for the traffic to clear, then get back in your car and go, it just doesn't really work out really well.
Yeah. Although I got to say, Lance, I'm not sure that's what your wife meant when she says she doesn't understand you. I think she was talking about a few other things.
Probably.
Um,
But that's a whole different
that's a whole different story. Yeah,
show.
exactly.
We'll have to do that show one day with our wives, but yeah.
I don't know. I think that would be we'd get few words in edgewise, and I think it would be yeah, it would be a lopsided beating. I think that we would both take from them.
Yeah.
All right, so let me talk about the road ahead from here. So uh, we've got the S&P, at all-time highs now. It's what, somewhere around 7150 or something like that, around the time we're talking. Um, Again, the markets have been sniffing out good news. Oil had come down a bit, but it was still pretty elevated. But oil is actually now getting pretty whacked the day we're talking here. So let me pull up this chart here of WTI futures. And you can see here, Lance, how it spiked with the war. But now it's coming down, and it actually got in the 70s today. It's right in the low 80s at the moment we're talking here. But oil is really starting to correct here, as one would expect it to.
Right.
And obviously, the president had been saying all throughout this conflict, hey, as soon as this thing's done, oil's going to drop like a rock, right?
Yeah.
We'll see how low it goes, but the dropping is certainly in process right now. Um, if indeed the war ends, if there's a peace deal in the next, week or two, would you expect oil to basically get back down to where it was pre-war pretty quickly, or would you think it might stay elevated for other reasons?
There's a couple of factors that are going to come back into play here. If we're able to get production back online and solve some of the bottlenecks that have occurred over the course of the last month pretty quickly, then you should see probably oil get back down into the 60s, maybe low 70s. If if things stay, if that bottleneck is more restrictive, you're probably going to be mid 70s for a while. And so
Okay.
we'll see.
But that's not that bad, right? I mean, isn't that kind of the sweet spot for the industry?
Oh
Isn't that
yeah,
where
no,
everybody likes it to be?
well, no, that's the interesting thing, right? So can you pull your chart back up real quick?
Yeah, sure.
Um, that's the interesting thing is that I was just talking to an oil and gas driller this past week, and it's interesting. Oil, you would think at these high oil prices, right? Everybody be just going like, man, I'm gonna go drill wells like crazy. That's not the case. It's actually not good because all the cost of the drilling goes up massively when oil prices spike like this. So the opportunity to go out and pop a new well and drill it really isn't that good. In
Well,
this,
sorry to interrupt, but I think the big reason why, correct me if I'm wrong, so what you're saying isn't wrong, but
right,
is the forward futures contracts for oil, the further you went out, they weren't moving, right? So the
correct.
oil industry didn't trust today's high prices because they're like, I'm not going to go out and put all this work in to explore and drill or produce extra because in 3, 4 months, the markets are pricing that oil is going to be back pretty much down where it was, and I'm not going to be making a lot of profit for that additional cost.
No, that's what I was, you jumped the gun on me. That's what I was
I'm sorry. Yeah,
because at those high oil prices, oil producers are incented to go sell their inventory, right? I'm getting $100 a barrel, boom, I'm going to sell everything I got. So
right. I
supply
got it in storage where it was $50 for me to pull it out of the ground, right? I get to sell it for
exactly.
2x. Yeah.
Right. So yes, we get back down to the 60s and the 70s. That's a great sweet spot. They can produce, they can drill, they can make money. Everybody makes money. Gasoline prices will come down, but not back to where they were before. They never do. So,
Hmm.
we get used to that. So prices are going to stay elevated for a while on gas. But no, but look, the futures market has been pretty good about predicting where oil prices are going to be by mid-year, and we'll probably get back down to that level. Supply comes up, you're going to get a little bit depressed in prices. And again, I listened to the interview that you had with Doomberg a while back, and a lot of
Hmm.
his comments were right. I don't know if we get back down, from my takeaway, and you can correct me if I'm wrong, is that he was really expecting a big oversupply of oil, and that was going to drop oil prices down potentially into the 30s, 40s. There's certainly an argument for that. I'm not sure I think we may settle in the 40, 50s ultimately
Hmm.
because there is a
Just to be clear, for his outlook is sort of a double whammy. It is um, there will be increased production, right? So those flows are going to come on, and of course, straight opens, all that oil from the Gulf comes back out as well, in addition to other people increasing their sales, right? I mean, every net oil exporter has been increasing what it's been selling. It might be pulling from reserves, like you were saying, but they definitely had a huge incentive to sell more. But he also was anticipating an economic slowdown caused from the oil price shock, which is still a TBD, and that's one of the questions I want to get to pretty soon with you
well,
as to
that's
whether there
why
might be some knock-on effects. But
that's
just to be clear, Doomberg's case was that 1-2 punch.
gotcha. Okay, well that's why I'm thinking 40, 50, maybe mid 50s as but that would coincide with an economic slowdown. I think to get into and again, this is just my opinion, and I'm not
Yep.
arguing with Bloomberg either, because I don't have a disagreement with his view. I think to get down to 30, 40, you need a recession. And I'm not sure we're going to get to a recession. I think we're going to see a slowdown though from this oil price spike.
Okay, so do I want to go there right now? Yeah, why not? Let's go there right now. So, um, again, let's hope that everything that there
Uh,
is a peace
real,
deal.
real- real quick,
Yeah,
I'm sorry, I asked you to bring the chart up of your FinViz real quick.
yeah.
I wanted you to change the symbol. Just in your search bar at the top right there, put in XLE.
Uh,
Up in the left corner, right under the FinViz logo.
oh, right there. Okay,
There.
great.
Type in
XLE.
XLE. Perfect.
Yeah.
Yeah, so this is the energy ETF, right? And it's had this massive run really since the beginning of 2026 on this whole idea of economic reflation. And we were having this big reflation trade in the economy. Boom, strong economic growth that was going to lead to bigger demand for oil prices. Then, of course, you had the continuation of that move higher with the onset of the Iran crisis. But if you're long energy stocks, we were talking a couple of months ago, a couple of weeks ago, that we were trimming our energy stocks in our portfolio and taking profits because the reversal of that spike is going to be pretty significant. I mean, it would be very easy to see XLE back down into the kind of the
High
$50
40s.
range. Yeah, the high 40s, low 50s. That would not be surprising.
Okay. Well, it's mid 50s right now, so it doesn't have that long to go
Yeah.
until it's in the low 50s.
Yeah.
So yeah. Okay. So excuse me.
So
We have
yeah,
been
now
talking.
back to where you want to go to next.
Yeah, that's fine. I just want to note that we have been talking around here about getting into energy
Mhm.
because it looked really depressed and it looked like the sector might be positioned to do well. And I had Rick Rule on who talked about why he was so excited about the longer term future of oil. Nobody was pricing in the war at that point in time, but the stocks had taken off in advance of the war, as you can tell here. I mean, the war didn't start until about here.
Right. And that's
So
that reflation trade we were talking about.
yeah, that was the reflation trade. So, anyways, this is the war premium, which is now gone, right?
Mhm.
But I'm curious, Lance, the reflation trade, right?
Right.
Is there
That's
still a
it.
good argument for that? And there might be, and I want to talk with you about that in a
Mhm.
minute. But before we get there, let's address the thing we were talking about earlier.
Yep.
So, there's been an oil price shock, right? So just like with higher interest rates, you generally say there's a lag effect that's going to manifest in the economy. An oil price shock should manifest a lot faster in the economy than an interest rate hike. But is there some sort of economic slowdown that is making its way to us through time because of these higher oil prices?
Yes, and that's why, this reflation trade I think is at risk. So if you pull back up that chart of XLE, that's why I think don't
I'm
pull it.
sorry, I keep pulling it down too early.
No, it's fine. You don't need to pull it up because I
Okay.
think people saw it. But that's why I think you can get down into that 46, $47 range on XLE. Because if you have an economic slowdown, that's going to reduce demand within the economy. And we're already seeing savings rates for the average consumer drop. You're seeing delinquency rates rise on
Yeah.
credit cards and
That's
things.
the whole K-shaped economy thing we've been talking about, but it hasn't mattered, right? The top half of the K has overpowered the lower half.
Correct. But again, that's going to get reflected back into oil and gas demand. And that's why I think that energy kind of XLE and particularly the energy stock
Yeah.
complex is an ETF. Now, look, there's going to be some companies that do better than others, always the case. But I do think you get a pullback here to where the economic balance comes back into effect.
Okay, so help me figure this out then. So we just talked a little while ago about you thinking, okay, maybe a short-term pullback in the markets, but then higher prices ahead, right? The resumption of the bull trend. But now we're talking about an economic slowdown in here. So when do you think this happens and what does the world look like in terms of the economy and the markets? Does the economy get dragged down for long enough for the markets to have to roll over at some point this year due to this price shock?
Well, so that's a great question, and that's the only thing that matters, which is what if the economy slows down or we have a recession? What are we actually talking about, right? And I think this is the disconnect that happens a lot between people that are very macro focused and the markets. And
Hmm.
there's a little bit of a disconnect there. We're just like, okay, this event, and I'm a macro guy, so this event is going to cause the US economy to go into a recession. Okay, that's the argument. Well, then you look at the markets and go, okay, well, what does that mean for the markets? All it means for the markets is what does that mean for forward earnings estimates? Because the markets trade
Yep.
on forward earnings. So whatever event you're looking at, so right now Goldman Sachs expects that year-end earnings for the S&P 500 will be $309 a share. Earnings for small and mid-cap growth companies, which are the most affected, by the way, by economic slowdowns and advances, are expected to grow earnings at 49% this year. Now, that's down from 60% earlier. Like in January, they were at 60% growth. That's now fallen to 49%. So if the market begins to really be concerned about forward earnings estimates, and that's why I said I think later this summer, potentially we could see another 10 to 15% decline potentially going into the midterm elections. That would also align with whatever kind of oil, whatever impact this oil spike is going to have. I think it's going to start to show up in summer in the
Okay, and that was kind of where one of the questions ahead for you is that prediction that you made, was that more because of the oil price shock and its ramifications, or was that more
I think
kind
it's
of the
too.
general uncertainty you have going into a midterm election?
I think it's both. First of all, and again, that those aren't really disconnected, right? So if I'm going into an election, how do people vote? Do people actually vote for the person that's going into office, or do they vote for how they fill in their pocketbook? If the guy in
Well,
office,
it's always number two, and
yeah,
so that depends on whether they vote for the
I
guy
mean,
in
we
office.
we could be running President Reagan right now for office if we could digging back up and do a weekend at Bernie's thing, and it wouldn't matter. He wouldn't win if the economy's in the tank. And so these two things are going to be very closely correlated. So if this oil spike translates into an economic slowdown that weighs on the consumer, there's almost a guarantee, historically speaking, that the Republicans are going to lose either the House, the Senate, or both.
Sure. So let me put my Lance Roberts hat on then, which is, hey, but the market knows all this. It has priced it in. So you would argue right now the market is not pricing in an aftershock from or it has priced in an aftershock, but it's small, so small that we're at all-time highs now.
Well, that's what it thinks right now. But again, the market is fickle. The market can change its mind as well.
Hmm.
So as the data shows up, if all of a sudden the market says, "Oh, I was wrong about the impact, the size of that impact," you're
Yep.
going to get another 5, 10, 15% correction in the markets. Again,
Okay.
that wouldn't be surprising at all.
Right. And so just to be clear, and I'm just trying to clarify for viewers
Yeah,
here, your professional gut is telling you that the market may not be fully pricing in the aftershock here because you're thinking, yeah, we probably will get a 10 to 15% correction midsummer.
right. But I could be wrong.
Well, of course, that's why I said gut, right? Yeah.
Yeah, I think I think there's a risk, but again, what we need to pay attention to is the market, because the market can change its mind. As you saw just a couple of weeks ago, I mean, like that, we're down 10% in the market. So and then boom, just like that, 2 weeks we're up to all-time highs. I mean, so the market
Right.
can change its mind very, very
The,
quickly.
the market can, and everything you're saying is right, but there's a little bit of a difference where the market was reacting to new data with the war, right? Whereas I think we have a lot of the data for the oil price shock. Like analysts can do the math. They know how high oil went. They know the impact that had on country X, Y, or Z or whatnot. So, unless there's something new that's a surprise in the future, um, you know, they they've already run the numbers more or less.
They've run the numbers and they have adjusted earnings to some degree, not a lot. And so the question is have they adjusted earnings enough? Because they
Yeah.
only lowered estimates for the first quarter, right? They haven't lowered estimates for the second and third quarter. So they're not real. I don't think that Wall Street is pricing in the impact of the oil shock yet in earnings. Now, look, they're not going to start cutting estimates until after we finish this quarter. So about 2 weeks from now, they'll start looking at Q2, Q3, Q4, and they'll
Yep.
probably start bringing those estimates down in anticipation of what this impact might be. So again, how drastically they bring down those estimates is going to have a very big impact on what the price of the market does.
Okay. So I want to talk about reflexivity here. Um, so
I'm a
uh,
favorite.
what's interesting is we could spend a lot of time on this. I don't want to because I want to get some other points. But I was reading an article the other day, and this is simplistic, but I think there's some truth in the logic here, which is essentially why didn't the lag effect arrive in the economy that you and I thought was going to happen from the higher interest rates in 2022, right?
Too much,
Pardon me?
there's too much money in the system.
Yeah, well, okay, so where did it come from? But I think the answer to this was, this is multifactorial, but kind of the main reason this guy said it was because of the reverse repo program. And we talked about this, but the reverse repo program just had so much damn money in it that as it was drained to offset the higher interest rates, it pretty much it pretty much negated them for the
Yep.
most part. And that's a huge reason why we didn't tip into the recession that everybody thought was inevitable from hiking interest rates the most violently we had ever done before in this country, at least in terms of the speed. Um, and so in this case, there might be a similar reflexivity of going on in the markets. And I don't know, folks, so take all this with a huge grain of salt. But the world said, "Oh my gosh, I can't get access to the oil that's in the Gulf." Well, a lot of other countries, like America, said, "Well, we'll sell it to you." Right.
Mhm.
And so countries were still able to largely get the oil they needed to run their economies. Yes, it was more expensive. That is going to hurt some economies here, but other economies are, doing a lot better as a result of that, right? It's a net flow of revenue into them. And
Yep.
so it may not be this singular shock going through the world economy. It might be a series of, well, this country's down, but this country's up. And it might kind of negate itself or partially negate itself the way in which the reverse repo program offset the higher interest rates.
And I think it's going to be fascinating to see now is like how many countries, we talked about Saudi Arabia building a pipeline, right? It'll be interesting to see how many countries look at this Strait of Hormuz issue and go, we always knew that was a risk, but we didn't realize how big of a risk that was. We're going to have a backup plan.
I have been making this point a lot recently. So, Lance, I guarantee, I'm going to give my personal guarantee on this, that whatever the percent of the world's oil is that's done through the Persian Gulf going forward, it's going to be lower than 20%.
Yeah.
The world is going to say basically, you know what? It was cheap, it was, whatever, but and I'll still buy from there going forward, but I'm just not going to buy as much. I'm going to have to source from other places just to have some more resilience in my oil supply going forward. I think Iran, I don't think they kill. I think, well, if the peace deal gets struck on what they're talking about right now, I don't think as Iran has killed its golden goose, but I think it has permanently injured its golden goose.
Right. Yeah. It's definitely a one-legged goose.
Yeah, there we go. Or it's just going to lay fewer eggs going forward than it did before. Yeah, well, however we want to murder that analogy.
Look, it's just I think this is going to be the most fascinating aspect to watch post this event is how all this plays out, and I think there's going to be a lot of things that occur that there were so many people that were so set that Iran, a couple of weeks ago was like, oh, Iran can control the strait, nobody can control that, but then blah blah blah. And we're finding out that's not really the case. And then, as you're saying, I think a lot of people are going to start figuring out workarounds, and it's going to greatly change the dynamic of that dependence, and that's going to really change the way the future oil market looks as well. So I think it's going to be exciting to watch, and I think there's going to be some really great opportunities to invest in that.
Well, that'll be really interesting. And I've asked people, where do you think the opportunities are in the Gulf? And they don't necessarily think it's in the the big producers per se, but it's a lot of the midstream stuff.
Yep, I
Yeah.
agree.
Um, So, at the risk of sounding too egoistic, I'm going to pat myself on the back a little bit here too. And folks, there's a good degree of luck in here, but regular viewers of this channel have known that for I don't know 3+ weeks now, I had really begun asking the question about why don't we just essentially create a naval blockade of the Persian Gulf rather than going in there, rather than the issues of Karg Island and boots on the ground. Why don't we just sit outside the Gulf and the Arabian Sea, which is where our Navy is already parked, and just interdict Iranian oil? And essentially, that's what's going on right now. And it seems to have been the final boot on the neck that is getting Iran to go to the negotiating table and hopefully strike a peace deal with us. Um, so it'll be interesting to see what happens from here. But that does seem to have been, it seems to be real validating of just the wonder I had of like, why are we not doing this? And maybe the answer to that was That was the plan all along, and we just had to degrade Iran's ballistic capabilities enough before we felt comfortable doing that. And I could totally understand that logic. But let's just lean back for a second here, Lance. Um, uh, let's assume a deal gets struck here. Uh, you know, what are the knock-on effects coming out of this? And we don't know the exact terms of what that peace deal would be yet, but if we can assume it's Iran gives up its nuclear, its enriched uranium, which in today's headlines seems to be very much the US's number one requirement of this deal, that Iran agrees to not overbuild its ballistic missile capacity. Because as I understand it, that was really kind of the trigger of all of this, was that Iran was essentially acceleratingly pursuing what I call a porcupine strategy, which was we're going to build up our ballistic capabilities so much that no one's going to be able to attack us to compromise our enrichment program. And
Right.
the U.S. basically said, hey, if they get beyond a certain level of ballistic defenses, that might be true. And if we're ever going to stop their enrichment program, we got to do it now before they get to that critical level. And look, I know I'm going to get flamed in the comments by people who say, Adam, you're totally swallowing, what the administration's telling us. That wasn't the case at all. But as best I understand, this is the rationale that's been put out there. So if Iran, it sounds like what we're saying is look, Iran will stop bombing you and we will give you back, I think they're saying right now, 20 billion in frozen assets. But there's going to be conditions on what you can spend that 20 billion on. You can't just go and basically, buy a whole bunch of missiles with it, right? You're going to have to use it for the good of your country, rebuilding your infrastructure, that type of stuff. So again, we don't know if this is going to get agreed to, but let's just assume it does for a moment, Lance. So if this conflict ends with America basically saying, we have demonstrably set back Iran's nuclear program. We have agreements in place with enforcement that give us as much confidence as we can right now that Iran isn't going to be pursuing nuclear weapons for the next couple decades at least. They're not going to arm themselves to the teeth ballistically, whatever. And we have this reflexive response from the rest of the world that's probably going to say, look, I'm not going to buy all my oil from the Gulf anymore. And America, you're one of the guys who's open for business. I'm going to buy more from you. And presumably Iran is a little bit less of a threat in the world. I'm sure there's going to be
Mm.
restrictions in here about you can't spend that money on funding Hezbollah and the Houthis and stuff like that. Do you expect a material kind of new peacetime premium to come into the global economy and perhaps the markets after this?
I honestly have no idea. But I think if you can remove the threat of a further conflict, right? And I'm not saying, look, that however this peace deal works out, if it just basically puts Iran kind of on the back burner for right now and it's not an immediate threat, things go back to normal. Yeah, I think the markets are going to trade at a premium on
Okay.
that because you've removed a geopolitical risk.
I was going to say that's not going back to normal. That's going to back to better than normal.
Well, yeah, exactly. And what,
Yeah.
what I just mean, yeah, yes, you're correct. But yes, and I do think at that point the markets are going to trade at a premium on that simply because you've removed that underlying risk to the markets. But again, this was the interesting thing is when you think about, what happened with the Strait of Hormuz and all that, like, well, oil prices spike. Okay. But if you really kind of start to step back and look at the markets, there were a lot of companies that really oil companies in particular, they benefited from that spike in oil prices. But how did the spike in oil prices, how is that going to affect, say, Meta's earnings or Google's earnings, which those are primarily ad-based revenues to a large degree? Yeah,
Not at all, right?
or at least very little, right? And this is the thing when the market sells off. We were just selling off everything because of this risk. And as a good investor, what our job is to step back and say, okay, well, what's really going to be the impact of that on? And this is why we bought Microsoft last Tuesday, because when you look at this, Microsoft's been under a huge amount of pressure, trading at a big discount to valuations and extremely oversold. And I was like, as soon as they get some resolution here, Microsoft's going to scream. They're going to do very well. And they've had a huge run since then. But, those are the type of things as a good investor to try to, set the headlines are great, but macro doesn't drive the market. And what our job as investors is to step into the market and say, okay, who wins, who loses, and let's make some bets. And that's what we do in managing the portfolio.
Yeah. Yeah, I made a note to myself, I think 2 weeks ago talking to you, and then last week talking to Michael, like, and I see here in my notes here, buy Microsoft. And I didn't. I just got busy, and I just pulled up the chart as you were looking, you were talking. I was like, oh, geez, well, missed that one.
No, it's going to pull back. You'll have another opportunity. Buy it next time.
Okay, yeah. If we get your thing. Um, all right. So, uh, let me ask you this, Lance. So, I want to talk to you about the reflation trade,
Okay.
where you said earlier, it's under threat right now. It doesn't. I don't hear you saying it's not going to happen, but you see it's got some challenges to it, especially if there's some ramifications from the oil price spike still to drop from here. But let me ask you this. There are Well, okay. So first off, there's a video launching tomorrow after this one, the day after this one releases, with
Okay.
Craig Fuller, and he's the CEO of FreightWaves. His company is, I think, the largest out there that tracks all sorts of transportation data, right? What's happening with trucks, what's happening with trains, what's happening with shipping. And you may remember I interviewed him in early November last year, and he was pretty despondent. He was, talking about how flows had really fallen off, but was very sort of depressed about the way in which the administration was handling the communication of tariffs. Right, this
Mhm.
was all still in the post-Liberation Day shockwave of like nobody knows what tariffs are going to be, right? And so a lot of companies were delaying their capital expenditures because they didn't know what they were going to be paying for tariffs. Um, Man, Lance, he could not be singing a different tune more than he is now. He is incredibly bullish about the economy of real things, which when I talked to him back in early November, he was like, we're essentially in a recession in the economy of real things. Um, so he said, it was funny. He said, like, Adam, like 2 weeks after I talked to you in November, it was like everything sort of turned on a dime. And I think that's because a lot of the tariff policies were getting clarified and we were starting to strike trade deals with these other countries. And so a lot of that uncertainty was getting removed and the flows that had been delayed were now starting to really flow. And he says this is a manufacturing boom. That's what's sort of at the center of this. It's
Yep.
America's making things again, which is part of the intended policy of the administration.
Right.
And he said, look, unless you are importing to America, he was like, if you are bringing things here on ship, um, it's still pretty weak, and the war is impacting that part. But he said, from a trucking and railway type of thing, shipping things from the center of America out to the rest of the world, things are booming. He sees the momentum continuing to build. And he said actually the war is kind of helping right now. He said a lot of American manufacturers, they're not really that exposed to the price of oil because like 80% of manufacturing in the US is powered by gas, and those prices haven't gone up nearly as much. Um, and anyway, so I mean, folks, if you want to hear some real bullishness on the U.S. economy, listen to this interview tomorrow with Craig. Now, Craig was careful to say, look, I'm not talking about the entire U.S. GDP. I'm just talking about the part of the world that I look at, which is the industrial part. But he said that is doing really well, and he expects it to continue building from here. So that would lend, definitely some wind to the back of the reflation trade from here. We are seeing retail spending pick up. So even despite the higher oil prices, people were worried that the higher oil prices were going to eat up all of the tax refunds, the record tax refunds that people are getting. But it seems like on a net basis, tax refunds are propagating. You're raising your finger, so I'll let you interject here.
Just be careful with the retail sales data. It's up because the way we measure retail sales is that we just measure it in dollars spent. So if I go buy gasoline at the store and I spend twice as much for gasoline, it registers as more spending. Real retail sales are expected to actually decline this month. So on an inflation adjusted basis. So again, just be careful with the nominal data because it's
Okay, I was talking to an analyst, I forget who it was the other day. They seemed to be thinking that it was on a net basis, even in terms of unit sales and stuff, that it was up. But you seem to
well,
think otherwise?
no, no, we haven't got the numbers yet. I will not be surprised You just had a 0.9% jump in CPI. So you subtract 0.9% out of your retail sales increase, right? I think you get a small negative print, zero point 0.1, zero point 0.2 on real retail sales for the month. We'll see. I mean,
Okay. Well,
you know,
let's earmark that and let's look into that next month.
but the point though is that a lot of that you really have to look at retail sales on terms of a real basis, not nominal, because God, when you have an oil spike, it really kind of skews the data.
Okay, see, I totally get that. So let's look at it with a fine
Sure,
magnifying glass when we
we'll do
get
that.
the numbers next week. But the point being here essentially is that there still seems to be some of the tailwinds that the administration was telling us they were, expecting from what they did over the past year to really start propelling this economy. So I think the question here is, especially given what Craig is saying about the industrial economy, is what is going to derail that? What is going to get in the way of the reflation trade? And I guess let me ask my big question, then I'll let you run here, which is, folks, I'm not saying this is going to happen. This is not a partisan comment. It's just a thought exercise here with Lance.
Sure.
But Lance, what if Trump sticks the landing here? Right. So a couple of weeks ago, people were like, the president's, hurtling us into World War III. What if we end with, hey, we got our enriched uranium, they're a diminished threat going forward, oil prices have come down, the tailwinds from everything we did are now starting to propel the economy forward. Is there the potential, and they always been, before the war, they've been promising the golden age of America arrives this year. Is there potential here that by the time that person goes to the ballot box in November, the Iran war and its concerns are ancient history, and they're looking at the jobs market around them and saying, I'm starting to feel a little bit better about my prospects. I don't necessarily want to say they're feeling like they're earning more money yet, but maybe that could be happening. Could this jujitsu from, oh my God, the Republicans are going to lose both houses of Congress, as you were just saying, to, oh my God, they did it.
Yep. It's very possible. My concern is that again, just from the reflation standpoint, is that the companies most there's two points on this. The first is that small and mid cap companies are the most susceptible to changes in supply and demand within the economy. Large cap, an Apple, a Google, those type of companies, if the consumer slows down a little bit, it's not really going to affect the earnings that much. But a small and mid cap company that is much more sensitive to that's going to show up in their earnings very quickly. So if we do have an economic slowdown because of the oil price spike, if we do have some retrenchment, not a recession, just a retrenchment of spending because I ran out of money, that's going to impact the earnings of these smaller mid-cap companies. And that's why we're already seeing the estimates come down. Again, we were expecting 60% growth in January. We're down to 49% now. That last year they grew at 5%, just to put that in perspective.
Right. Yeah.
So there's a good bit of gap there in terms of bringing this down. The other side of this equation is that a lot of this industrial manufacturing boom is data centers. We're spending a
Hmm.
lot of money building out data centers. What if a lot of these planned data centers maybe get put on the back burner for 6 months or a year because revenues slow down a bit because of the oil price spike, or there's some other concerns that pop up, maybe a contraction from consumption due to that oil price spike that starts to impact some of the large cap earnings. And they just say, all they have to do is just say, hey, I'm gonna push this data center from 2025 to 2026. That's a big chunk of that manufacturing boom that's going on for the Caterpillars and people moving the dirt, those type of things.
Sure. Sure.
There's a,
Are we seeing any of that yet?
not yet, but
Okay.
again, I'm just saying these are the risks.
Yep.
Yeah. So, look, we have exposure to data centers. We own companies that, work in the cooling business. They work on the infrastructure side of the business in our portfolios because look, that's where it's happening. We want to be part of that. But I want to keep a real candid view on the risk that are there for that sector. And look, I'm
Yep.
all for the reflation trade. If it goes, I'm going to make money.
Yep.
I'm more concerned about. So here, let me back that up. My portfolio is built for the reflation trade. So as long as that works, I don't have to do anything. My job right now is to analyze all the reasons why that may not work out.
Got it. But that's actually really helpful though. But right now, your default is that the reflation trade is on because that's how
Yes.
your portfolio is positioned.
Correct.
Okay. That's actually really important information, I think, for folks to know here. Yeah. Okay. So obviously, folks, we'll be looking at this, and Lance, it sounds like we'll be looking at the Russell and the small caps. closely to see if they start indicating any real weakness here. And as you said, they've come down. Earnings estimates for them have come down, but that's to be expected during a period of war like we had here, right? So the key thing is going to be how well, if at all, do those earning estimates start recovering here if we indeed get a peace deal? And let me ask you this, just on the peace deal, do you expect that to be a sell the news event? Like maybe that's when the pullback happens?
Maybe. Yeah. I mean, again, there's been a lot of run into that. So that could very much be a buy the rumor, sell the news type situation.
Yeah.
And again, that would give you that. Look,
Because let's be clear, people are buying the rumor right now. This war is not over.
we are going to have a pullback in this market, right? I will go out on the limb and I will say we will not retest lows, but we are going to have a pullback 100% guaranteed to some level of support. Probably the 50-day moving average, maybe the 100-day moving average, somewhere in there, there's a level of support. Market's going to find that previous resistance, turn it back into support. That'll be your buying opportunity. But that's absolutely going to happen. Now, I don't think we'll retest lows, but we're definitely going to have a pullback. And so, yeah, anything that happens in the next week, and again, that pullback could happen next week. Um, Earnings disappointments could be the catalyst. We kind of get this news flow behind us. We're going to start looking at earnings. So if the mega cap earnings come in weak, as an example, that's going to give you a pullback in the market. I mean, so there's a lot of things, but to your point, yeah, we'll look back and go, yeah, let's buy the rumor, sell the news. But again, I think that's going to be a buying opportunity going forward until we have whatever next event's going to occur.
Okay. And just compliance note, folks, Lance said 100% guarantee, can't guarantee anything 100%, but he thinks there's very high probability.
Oh, geez, we brought them.
All right. Well, look, everybody's favorite pin that's been in the headlines recently, private credit.
Yeah.
Any news on that front worth talking about this week?
I wrote an article on private credit maybe 2 weeks ago, talking about why private credit isn't the next financial crisis, and
Hmm.
we went through that whole analysis here.
Yeah,
That
it's basically like a tenth the size of what the subprime
yeah,
market was, right? Yeah.
1.7 trillion versus 62. So it's much smaller than that. It's very very small. But Mike, the reason I just said that is Michael Leibowitz just posted another article about it yesterday on our website. So if you go to realinvestmentadvice.com, he just posted another article. It's a kind of a two-part piece. He's going through and doing the analysis back to 2008. But the bottom line is no, nothing else has occurred. We're still seeing, funds gate their redemptions, which they should be doing, as we talked about before. That doesn't mean that the loans are all going bad. I think there's going to be a really good opportunity for investors to pick up business development corporations that have gotten really hit hard here because just a lot of panic selling of just kind of
Yeah. I am hearing a lot of that and folks, if you didn't watch, folks, watch the video earlier this week I did with Jan van Eck with his Q2 outlook. He a quarter ago had mentioned that the BDCs, he liked the vehicle, but they were selling off, and it wasn't necessarily the time to buy them, but keep your eye on it. This time around, he was like, these things are selling at really stupid discounts. And importantly, what he looked at is he's like, these things are priced as if, I can't remember off the top of my head, folks, but it's like they're priced as if like 20 or 40%, like 20, for 20% defaults of their
yeah,
portfolio,
it's,
right?
it's
And he actually had the default rates, and he said they're actually still pretty much in historic alignment. And I'm doing this from memory. I'm probably wrong, but I want to say like 3 or 4%
yeah,
defaults, right?
very
So he's
small.
like, unless we see a huge increase in defaults, these things are trading at a really a historically aberrant discount.
Yeah, no, absolutely. And also too, if you look at a lot of these loans, they're over collateralized. So unlike subprime loans, which are under collateralized in a lot of cases, a lot of these are over collateralized loans. So again, the bottom line is that no, this isn't going to be a financial crisis. Could it cause some stress? Yes. Banks don't have a lot of exposure to them. They have a very, very small leverage exposure to these private equity funds, the private credit funds. So, a lot of that risk is really overblown, and I think the market's starting to already see through a lot of that.
Okay. I don't want to be dismissive of the risk of private equity to parts of the financial
1.7
sector.
trillion, it's not small.
Yeah. Yeah. And there are people I interview who are more worried about it than you, Lance, and Stephanie Pomboy. We just talked about this a few days ago. Um, but I am really not hearing that much from people like you and experts I talk to that this is the next subprime. So I just want to, and not saying that it couldn't metastasize into that, folks, but right now we are not yet seeing that type of risk.
And again, there's just the subprime crisis. A lot of people don't understand what we were doing during the subprime crisis because we were taking a mortgage and we were doing a derivative off that mortgage, and we were doing derivatives off that derivative and derivatives off that derivative. And it just went on and on and on and on. I mean, we took a $2 trillion subprime market and turned it into $62 trillion. And that's not happening with private credit,
Yeah.
right?
Now
So
that being said, and I think you agree with me on this, we don't know what's being done, what's been done in private credit, right? Because it's not regulated. So there probably is a material amount of just bad loans that are out there that shouldn't have been made. We just
maybe.
don't know how big that was, and whether they manage the risk of the rest of their portfolio as well. Only time will tell. But to your point, the size of it, even if it goes real bad, isn't, as we understand it, near the size that things were back during the subprime
Well,
crisis.
and also doesn't, and remember, look, most of the people in private credit, we talked about this before, but most people in private credit are accredited investors or people with high net worth. So I've got a portfolio of $100 million. I've got 20 million in private credit. It doesn't end me, right? Subprime crisis, we were giving mortgages to people that had no money, right? There was no
Right.
way they could pay that mortgage. They had no job. So we affected, the difference is that if the 1.7 trillion went to zero in the economy, it's mostly high net worth institutions. They can absorb it, they'll write off the losses, they'll move on with life. This isn't where we're going to wipe out the bottom 50% of the economy because they were all invested in private credit. It's just a very different environment than what we had with housing.
Yeah. Okay. So right now, you're not too worried about what's going on there. You
We're
and
watching
your,
it.
your partners there are watching it closely, but you're not taking a lot of action in your portfolio based off of this. Although I'm curious, are you buying any of these BDCs?
I'm actually about to launch a portfolio for it. So
On Civil Advisor?
maybe.
Okay, but so sorry, I'm sorry. This is not just an index you're tracking, but this is actually something, a portfolio that capital
Yeah,
will go into.
I'm actually constructing a portfolio that will generate a much higher dividend yield in the market, but will provide some performance relative to the market. Won't provide market performance, but some performance over time. It's a very interesting model. So hopefully I'll have something on that in the next few weeks.
Okay, so essentially this is to be a sleeve at RIA that if you're an RIA client, you can say, yeah, give me
Yeah, I have a lot of
4%
people. I have a lot
exposure
of
to that.
people. Yeah, I have a lot of clients. They're like, I really just want income on my portfolio. So this is kind of giving you an opportunity to build an income portfolio that if you just
Yep.
income, you're not so worried about, you just need enough growth to offset inflation and you're really looking for an income stream. It's something that might fit that bill.
All right, great. So folks, let me know because there's what you're talking about very much in the territory of Stephen Bavaria's Income Factory. And he has BDCs as one of the many different asset class types that he has in there. I did reach out to him about this a few weeks ago to see how things were going, and he was like, "Yeah, prices are down on these things, but he's like, the income's uninterrupted, and that's my bag. That's what I do for this for is the income. Don't really worry so much about the market price." Um, and obviously, Lance, if there is the potential for price recovery in a lot of these BDC ETFs that are out there, where you potentially have to get the best of both worlds, right? You get the above average yield, but you also get some price appreciation here. So this, if this is of at all interest to you folks, this might be a particularly good time to look at this. And just to echo Stephen, he invests in these funds like the Black Rocks of the world and whatnot. Where he's like, look, I only invest with the managers who have a great track record in the space, but are really big. And so therefore they can get the best deals. And they've got a great track record of managing risk here. So, there's not a lot of existential risk in the ETF. You've got diversification working in your advantage as well. So yeah, I mean, if they're trading at a discount, this might be a really interesting time to look at this. So folks, if you'd like me to bring Stephen on in the next couple of weeks and just kind of get his specific feedback on this, let me know in the comment section. And if there's enough interest, I'll reach out to Stephen. All right, Lance. I'm gonna take it to a non-financial topic, unless there's anything else that's really burning brightly on your radar that you feel you got to tell people about.
Can't think of anything. I think we've
Okay.
covered almost everything.
So we haven't really talked about this much, but it's been cool to watch, which has been the Artemis 2
Yeah,
program. It's really something, I mean, it's just cool in general, right? The space race, I'm sure for the boomers that are watching who can remember actually watching the Apollo program live when they were kids, and you're raising your hand. I was too young. Um, but it always blew my mind that we hadn't been back to the moon since I was 1 years old, right?
hmm
I mean, I'm going to turn 55 this summer. To me, that's just a real disappointment, right? I mean, I'm sure your generation, Lance, that was watching live was like, oh my goodness, this is happening in the late 60s, early 70s. Surely by the time the 90s get here or the new millennium gets here, we're going to have a daily shuttle to the moon and we're going to have space cars and all that type of stuff, right?
Yeah.
And we really,
Don't remember the
really just
Jetsons.
dropped the ball on it, right? I mean, yeah.
Yeah.
Um, so it's exciting to see, I would say the U.S. Uh, reclaim the lead here on off-world exploration, and I personally am just really excited about what could happen if we do return to the moon and actually eventually create a moon colony there, and all the things that opens up for additional space exploration and heading to Mars and all that stuff, but just all the innovation that will come out of that, right? There's so much innovation that came out of the space race that benefited us commercially and quality of life afterwards. There's just all sorts of good reasons to do this. And it's just, there's something about just sort of uh, the potential of the human species, right, to become extraplanetary and to learn more about the cosmos and all that stuff that's wrapped up in all this. And again, like I said, it's cool to see the U.S. reclaim this lead, but also it's one of those things that I think just should unite us as a species, right? Where we can just look back and say, this is really pretty amazing what humans are capable of. And when you see, they took the latest shots of the moon, of the Earth from the moon, right? And it's that whole pale blue dot, right?
Mhm.
Where you're like, it's sort of the lifeboat, like where it's like we only have this one planet. It's incredibly unique and precious to us. Why are we busy fighting with each other, right? Why are we busy doing all the stupid things that humans do to each other?
Yeah.
Where, why would we endanger screwing up this amazing gift that we have? And as part of that too, like we only have this one amazing gift. So let's get extraplanetary in case either we do something stupid or something out of our control happens, like an asteroid slams into the earth or whatever, right? Like we should just be united in leaning into our amazing ability to do incredible things and get out there and start,
See,
getting into the rest of the cosmos.
we had that, right? We've had that before. When we came back, when Johnny came home from World War II, everybody looks back at that age of the country and they go, wow, what an amazing period that was. I mean, you had this massive boost of innovation. We were having state fairs where, we were talking about the future and flying cars and all these types of
World
things.
fairs, although those predated the
Yeah,
war,
yeah,
but okay,
sorry.
go on.
Sorry, but yeah. But the point was is that everybody was united. When we came back from World War II, everybody was united in moving the country forward, recovering from World War II. We were the manufacturing epicenter of the entire world. We had explosive economic growth, wages were rising, interest rates were rising, inflation was going up. It was the perfect environment for the country, right? I mean, and it's a shame. I was just watching my X feed is a good example. There's this wonderful event that happened with Artemis, and again, it brought me back to being a kid sitting around, with the rabbit ears, trying to get the foil on the rabbit ear,
Yep.
get the picture to come in, all that, and it took me back to all that. What an amazing feat that was! You have to remember when we sent Apollo to the moon. They did that with the memory of a TI calculator. They were building this thing with a slide rule.
I think less, to be
Yeah.
honest.
And so it's just amazing that we did it back then. It's even more amazing we can do it now. And again, I look at my X feed and there's people like going, "Oh, this is stupid. It's fake. Why are we doing this? Blah blah blah." And just finding some reason to hate on this great human achievement. And to your point, if we could figure out how to stop being so divided, where look, it doesn't matter what President Trump does, he could cure cancer tomorrow, and the people that hate him are going to hate him anyway, right? But instead of spending all of our time worrying about that and fighting about that. You know what amazing things we could do if we could just all pull together and move in the same direction at one time. You want to cure poverty, you want to cure, whatever ills there are in America. We could do it. We could do it fast. We just all have to get on the same page. And we're just spending so much of our time hating everybody else. And, because we're miserable, right? We're not happy. So if I'm not happy, nobody else is going to be happy. We just keep actually sending ourselves backwards, and
Yeah.
we miss the value of this wonderful achievement that just got done. And some of the things that occurred on that trip were just absolutely fascinating.
They were, and I want to talk about one in just a second. But you raise an important point too, which is the point I was making, which is it's amazing what our species can do, and kind of the all, hey everybody, can't we just get along type of thing, internationally. But you're making a really good point too of domestically, we're about as divided as we've ever been, at least since probably like the Civil War. Um, and it just creates so much, it's like an energy suck, right? It's all this potential productivity that could be happening, but we're just infighting, right? And I understand a lot of the reasons for it, and I don't want to spiral off in this, but as I think about it, there probably are some foreign actors that are intentionally stirring up the internal friction inside America just because it slows America's progress down, right? But to your point, Lance, I guess if there's an ask out of this rant, it's like try to pick your head up from the daily divisions, folks, and look at the amazing things that we can do and that we are doing, and maybe try to just devote a little bit more of your attention and focus on those things, to just give a little bit more wind to their sails because there is so much amazing potential out there.
So
So
real,
go ahead.
real quick, Adam,
Yeah.
do you know that people that are optimists live 15% longer than people who aren't? So the point about that is if you just want to increase your lifestyle, learn to be happy, right?
Yeah. Oh, absolutely.
Stop
Absolutely.
worrying about stuff you can't control. Stop walking around with a big ass chip on your shoulder, hating everybody around you. Look, I don't like people. I don't go outside. There's people outside. I don't go outside. But the point is just learn to be happy, and your whole life will be better if you're more optimistic. Your life will work out better. If you're pessimistic, you draw negativity to you. If you're optimistic, you draw optimism to you. So pick the lifestyle that you want and learn to live in that lifestyle. If you like being miserable all the time, that's what you're going to attract. And I don't know why you want to live that way, but that's up to you. But if you want to have a happy, healthy lifestyle, learn to be optimistic, learn to be happy, and draw that energy to you because you'll have that type of environment around you. You cultivate your environment. So if you don't like your environment, look at the people you hang around with, look at the things you do, look at the things that you draw to you through social media. If you don't like your environment, that's the place to start.
So let me add to that. So first off, there's the old Native American adage or whatever. You got two wolves in you, and which wolf wins, and it's the one that you feed, right? So to your point, Lance, it's you basically become what you put your energies into. And look, I don't know if this is real or not, but I was watching a TV show the other day, that John Hamm, Your Friends and Neighbors, one,
I love that
and
show.
it's a fun one. And he was talking to his sister, and his sister has some mental health issues, and basically he was kind of looking out for her, and she's taking on some responsibility that he's worried are going to be too much for her and maybe cause her to uh, relapse. And she tells him, well, hey, look, there was this Harvard study or something like this where they had these two collections of rats. And on one cage of rats, it said, these are super smart rats. And on another cage of rats, it said, these are the dumbest rats ever. And then they brought in students to run these rats through mazes and had the students, basically rate the rats. And apparently the rats that were in the cage that were labeled the stupidest rats ever performed much worse on the experiments. And her point was like the rats were random rats. They were the same rats in both cases, but the students had an expectation of the rats to be failures, and therefore the rats then became failures. And so to your point about like what you choose to focus on and direct your energy to, that's totally right. The layer I want to add on top of that is your expectations of others, right? So if you think, okay, well, that guy thinks differently than me on this topic, and so therefore that guy must be an idiot, an ignoramus, a bad person, whatever, you're projecting a lot onto that person, and that's probably going to determine the destiny of your relationship with them. So my
Mhm.
point is maybe try to readjust a little bit and go forth in the world with a little bit more optimism about other people and our ability to interact and find common ground and stuff like that. And I do think, I don't know if that Harvard study was real or if they just made it up for the episode, but I think there is truth in that, which is if you go into something with a preconceived idea, you are definitely increasing your odds of getting that experience that you've got the preconception for, right? So shift your preconceptions to be a little bit more optimistic, a little bit more let's collaborate versus fight.
But if
Back, go ahead.
But real quick, if you do watch the show Friends and Neighbors, I highly encourage you not to pursue his career path.
Yeah. Well, it's not working out that well for him right now, if you're up to the latest episode. All right, so back to Artemis just for a second. So there was a great moment that happened there, Lance. I don't know if you saw it, but it was the one where the mission commander, where they named some newfound features of on the moon after I think both their ship or whatever, but also after his wife who had died of cancer. And I didn't know any of that. It's funny, I watched this happen live.
Mhm.
Totally moving, where he names the crater or whatever it was after his wife who'd passed away. And at the time, I didn't even know it was his wife. He didn't say my wife. He said, wife of whatever the guy's name is and mother of these kids. I thought it was like a teammate of theirs or something who had died, but it turned out to be his wife. And he did it. And then, all his crewmates come and give him a big hug. And it's just this wonderful moment of humanity. And I actually was so moved by it, I recorded it and then I sent it out on X. And initially, it didn't get a lot of response. And I was like, come on, people. Like, how can you, if you can't respond well to this, you don't have a heart. But again, to me, it was, I don't know how many miles away they were, but I know it's hundreds of thousands of miles away from the Earth, pretty much headed towards the dark side of the moon, farther away from the Earth than any human had ever been. And they still had this ability to, uh, demonstrate the best of humanity in the midst of all that. It was amazing. So anyway, did you see that?
I saw it and yeah, that was very moving. And again, that's the
Yeah,
whole thing about this. The stuff that happened on that on that voyage was just amazing. And people are just, when I look on X and people are knocking it down and trying to find some reason to degrade it, call it fake, whatever, I'm just like, what's wrong with you? You
yeah,
know,
I'm with you. It's like we don't get that many wins where we can find something that 100% of the people should agree on, right?
yeah,
Like that's pretty
one of them.
awesome, right? Yeah,
That's one of them right there that we should all
yeah.
about. Yes.
All right. Well, look, folks, like my ask from here is just leave this video today with a little bit more intent to you know appreciate what humans are possible of, and maybe help invite people to become their best selves, and in the process, try to be your best self as well. All right, Lance. Well, I think that's about it for the week. Um, Anything else we should talk about before we bring this thing to a close?
I think we've done a good rant, and I think we covered the market pretty well. And I think next week we could definitely see a bit of a pullback. So, kind of look for your opportunities, pick wisely.
Pick wisely. Okay. All right, folks. Well, so if you want some help in picking wisely, highly recommend that you get that from a good professional financial advisor. Importantly, one that takes into account the macro and market issues that not just Lance and I talk about in this channel, but all the experts and I talk about. If you don't have a good advisor who's doing that for you, consider talking to one of the ones that Thoughtful Money endorses. Perhaps you might want to talk to Lance himself and the team there at RIA. So to set up a discussion, just fill out the very short form at thoughtfulmoney.com and the firms will be in touch with you right away. Um, Please do me a favor, folks. Hit the like button if you haven't already, and also click on the subscribe button below, as well as that little bell icon right next to it. Lance, I want to invite you to join me in celebrating the fact that we just passed 175,000 subscribers on this channel. It's been a real journey so far. That couldn't have happened at all without you, the viewers here, subscribing. I mean, theoretically, or literally, it's just a count of how many of you have subscribed. But if you haven't yet, please do subscribe now because we want to get to 200,000 as quickly as we can. The more subscribers we have, the more basically YouTube gives attention to this channel and these videos and shares them with the world. Lance, you know this, um, but I had run a previous channel before here that you were on with me, and we got that one up to 300,000 subscribers, and then had to start over from zero when we founded Thoughtful Money. When I founded Thoughtful Money a little over 2.5 years ago, or about 2.5 years ago, and it's been a lot of work to rebuild it, but it's been more fun than it ever was. And so, again, a huge thanks to you for being part of that.
Well, and if you'll remember, but when you transitioned over, you were terrified. There's like, what if I can't do this? What if I can't build back? I was like, you can do this. It's going to be great. I was definitely in your corner for this. So I'm very proud of you. I think it's great what you've done, and I hope to see you continue to build it.
Well, thank you. And you definitely were. Again, I just want to give props where props are due here. Yes, I was worried. Oh my gosh, I had captured lightning in a bottle. Am I going to be able to do that again? Very, very grateful to
Rational,
everybody who came over with me. Pardon me?
completely rational to have that fear. Every time
Yeah,
this,
yeah, it was. But what really helped me get through that fear was the huge support and emotional propping up that a few key people like you did, Lance. So you were very important in that.
yeah,
So anyways, folks, if you haven't, long story short, if you haven't subscribed, please subscribe here. And last thing, if you're watching this the day that this video is premiering, it is the same day as Rick Rule's Copper Boot Camp. And I don't know if for those that didn't watch the video I released earlier this week with Rick, lots of reasons to be very optimistic about where both the price of copper is headed in the next couple of years, but how the mining companies in that sector will do. And if you still have time to actually watch that boot camp live, because it really just started, I think, pretty much right around the time this video is ending. Um, and even if you can't watch it today, if you go and register for it still, you'll get all the replay videos of the event, which you're going to need to watch anyways. As Rick said, it's like an 8-hour event. And he's like, you're going to have to watch these videos a couple of times to get all the information and get it to sink in. So anyways, if you want to take advantage of that copper boot camp, just go to thoughtfulmoney.com/copper and you can sign up for it. All right, my friend Lance, look forward to seeing you next week. Glad to have you back on the continent again after your English travels.
yep. So Italy's next. That's the summer. So
All
stay there.
right, look at you becoming a world traveler. That is great, and I suspect and hope that a lot of this traveling. It sounds like there was sort of a wedding or something involved this last time around, but it's just that you prioritizing taking some more time to enjoy life and smell the roses with your wife, given her wonderful news in terms of her health recovery.
Yeah, it is very much now realizing and again, this was a very valuable lesson. And unfortunately, we learn valuable lessons at the worst of times potentially.
Yeah.
But the lesson is that you do need to enjoy your life while you have the ability to do it. And, just work like you and me, you and I are both just workaholics. We work a lot, we're constantly grinding to grow our businesses. And that's all admirable. Nothing wrong with that. That's how you build wealth in the capitalist system. That's fantastic. But you also, I had a friend of mine tell me this yesterday. He's like, Lance, you got to learn to spend some of it. And so
Yep.
and so that's the goal. For as long as I have my wife with me, we're going to start spending more time together and enjoy
All
what
right.
we do.
Well, that is I'm gonna say that is gonna be a long time, and I wish you guys lots of new happy memories as part of that. So we were wrapping up, but real quick, a question here for the audience. Folks, if you'd like to maybe have me and Lance talk one of these in one of these videos going forward about exactly what Lance just mentioned, which is um, the importance of investing is it's a high priority. We do it because we want to set up a better, more prosperous future for us and our family and the people that we love. Um, but it's a journey, and it's a journey that you don't know how much time you have on it, right? Hopefully, you got a lot of time ahead of you, but the proverbial bus could hit you tomorrow, right? And so, yes, you want to be building your capital more and more as time goes on. But Lance, I presume you also want to be taking time to spend some of it along the way to make sure that if luck's just not in your favor and you've got less time than you think, you're at least getting living done along the way.
Exactly. Yeah.
Yeah, I mean,
My,
I talk about Thoughtful Money's mission is to help you fund your life goals. That's what
Yep,
I'm trying to do is to increase your odds to do the things in life you want to do,
that's right.
but you don't want to have them all in the future. You want to have some of those goals here in the present.
That's what we call scooping. We call that bucket scooping within our firm. So when we're doing financial planning, we set up all these kind of life goals. And then when the portfolio does really well, we scoop a goal that was in the future. We move it up. We do it now. Want to remodel your kitchen? We had a great return last year. We're doing that this year. You want to travel? We set up these buckets, and then as those buckets come due, we scoop those, move those forward to make sure you can fund these experiences, but still not deter from your financial plan.
All right. So yeah, folks, if you'd like to see a more detailed discussion about this and kind of the mindset and the behaviors to adopt in it that Lance and his firm recommend, let me know in the comment section. If demand is high enough, we'll integrate that into a future video here. All right, Lance, my friend. Well, look, yeah, get out of here and go have some fun with your wife.
Absolutely. See you next week.
All right, everybody else, thanks so much for watching.